Assalamu alaikum, brothers and sisters. You may have heard a lot of news about people investing in the stock market, or other financial concepts such as mortgages, and leasing cars, etc. It might come across your mind as to whether or not these things are halal or not. In order to understand these concepts from an Islamic perspective, we first have to understand what Islamic finance is. So that begs the question, what is Islamic finance? Let's first define what regular finance is. Simply put, finance is the management of money. There are three main types of finance: personal finance, business finance, and government finance. An example of personal finance could be creating a budget for buying groceries, or saving up money to buy a car. An example of government finance could be the government raising taxes to finance government expenditures. An example of business finance in the West would be someone getting a loan to start a business. Let's look at this example in more detail. In Western finance, traditionally, if someone wanted to start a business, they would take out a loan. Here in this example, we have two people, the lender and the borrower being someone who wants to start their own farm. The lender lends $10,000 to the borrower at a 10% interest rate. Now let's say that the borrower uses the $10,000 to buy a farm, and the business was successful, so the borrower makes $13,000 in profit. The lender is still down $10,000 because the borrower hasn't paid back the loan yet. And the borrower owes $11,000 because of the 10% interest rate. Then, the borrower pays back the $11,000. In this example, the lender was the supplier of capital, and the borrower was the laborer. Capital in this case is money used to buy equipment and buildings. The borrower used this capital to buy the farm and farm equipment. Both the lender and the borrower make a profit in the end. This is how a successful traditional loan would look like in Western finance. Now, in Islamic finance, the dynamic changes. The dynamic of a supplier of capital giving capital to a laborer is still the same, but what changes is how the profits are distributed and who the people are. Instead of there being a lender and borrower, there is an investor and entrepreneur. And instead of earning interest, the investor participates in a profit ratio with the entrepreneur. In this case, the investor earns 60% while the entrepreneur earns 40% of the profits. Let's say that the entrepreneur now earns $20,000 in profit. Instead of having to repay a loan, the entrepreneur must share the profits with the investor according to the profit ratio of 60% 40%. Now, the profits are distributed accordingly. The investor takes $12,000 of the profits, while the entrepreneur takes $8,000. Since the investor invested $10,000 initially, the investor makes $2,000 in profit, while the entrepreneur makes $8,000 in profit. This is an example of a successful investment in Islamic finance. Now that we looked at an example, we can talk about the foundations of Islamic finance. Islamic finance rests on the application of Sharia, or Islamic law. This consists of the Holy Quran and Hadiths of Prophet Muhammad, peace be upon him. Some principles of Islamic finance are that it is risk-sharing in nature, promotes wealth generated through legitimate trade and asset-based investment, and forbids charging or paying interest. Now, what do these terms mean? Let's look back at our previous example of an Islamic investment to fully understand. The initial investment stays the same. The investor invests $10,000 into the business, agreeing to a profit ratio of 60% 40%. Since interest is forbidden, the investor invests into the business instead of giving out an interest-based loan. Now, let's say that instead of making a profit, business goes bad and the entrepreneur makes no profit at all. The investor loses the initial $10,000 they invested, while the entrepreneur loses time and effort. This is what risk sharing is. The investor takes direct part in the profits or losses of the business, and if the business does poorly, the investor takes a hit. This type of model is also considered to be legitimate asset-based investment because the investor is trying to make profit off of something that is real and tangible, in this case, the farm's produce. In the other example with the loan, the lender makes money off of money, which is not based on a real and tangible asset. To understand these terms in further detail, let's look at the other example with the loan again. The initial loan amount is the same, a $10,000 loan at a 10% interest rate. This time, let's assume that the borrower's business goes badly and he doesn't make a profit. The borrower still has to pay back $11,000, despite the fact that he didn't make any money. As a result, the lender makes a profit of $1,000, while the borrower takes all of the losses and loses $11,000. As you can see here, this is an example of the lender not sharing in any risk whatsoever. There is no risk involved when you are giving out a loan, as you are almost guaranteed to get your money back plus interest when you give out an interest-based loan. It doesn't matter whether the borrower's business does badly or not, you can always chase them down for their money without any penalties to yourself whatsoever. The lender also did not make any money from legitimate trade or asset-based investment, as all the profit he made was off of lending money, not out of any actual productivity. The next principle of Islamic finance is that it does not allow speculation. Speculation is when the ownership of goods depends on an uncertain event in the future. Examples of this include gambling and life insurance. Life insurance is considered speculation because the insurer promises to pay your family members a large lump of money for when you die, in exchange for you paying a premium to them every month. The thing is that you don't know when you're going to die. This knowledge lies with Allah alone. And since you don't know when you're going to die, it is possible that your family members may not receive the benefits of this insurance since you may outlive the term length of the contract. Thus, this is a form of speculation that is prohibited by Islam. The next principle of Islamic finance is that you cannot invest in haram businesses. These include industries that deal with alcohol, drugs, gambling, pork, and explicit content. The last principle of Islamic finance is that you cannot engage in contracts that include excessive uncertainty and risk. An example of such a contract is selling crops that haven't grown yet. This is considered too risky because you don't know whether or not the crops will grow successfully or not. As you can see, Islamic finance provides a much more ethical and sustainable framework as compared to Western finance. It is because of the rules set by Sharia that allows Islamic finance to be less risky and volatile as compared to Western finance. In Western finance, the lack of prohibitions set by Sharia is the reason why so many financial crises happened within the past century, like the Great Depression and the global financial crises. Western finance has its own massive set of problems that hurts our economy. But that is a video for another time. If you like this video, please like, share, and subscribe. Thanks for watching.